Thanks, Alicia. Well, we're joined by James Turp. He's senior dealer over at Nedbank Capital. James, a very good afternoon.
Hi, good afternoon, Stephen.
Well, James, it looks like there's not much good news out there. We had some negative news out last week about the US housing sector. That's continued through to this week. More poor jobs numbers yesterday. And of course, we had that Chinese PMI out this morning and really setting the ball rolling for another negative day on global markets.
Exactly, yeah. I mean, overnight, this week the moves have been negative, certainly. I mean, the Chinese PMI number has disappointed the markets. That is seen as the largest growing economy in the world, and with that contracting, markets not taking it very favorably. It is probably worth bearing in mind the People's Bank of China has looked to try and cool down what they perceived as an overheating economy, and with property prices bubbling over there. So some of those measures obviously coming through in it, and perhaps maybe also anticipating a drop in demand from the rest of the world, given the state of Europe and America at the moment. So not a good number overall though.
Just looking at our own PMI, which came out about an hour ago, 48.4, so it's below the 50 level for the first time since last October. Any market reaction to that?
Yeah, the initial market reaction was, as you would expect, lower in yield terms, as perhaps that indicates that certainly the economy is slowing down. If you look at the numbers, most significantly, the employment level are coming in at around 45, below the 50 point of expansion. Business activity also dropped to around the 45 level. That could be, they're saying, as a result of the World Cup, perhaps dropping productivity, which would also follow through into the July number. So it will be worth keeping an eye on that. Some positives are that sales orders are still above 50, and backlog of sales, although below 50, increases. So it's showing that there is some demand in the economy. They're also saying that the stronger rand perhaps affecting exports. So a mixed bag, not a good number. Perhaps the World Cup is muddying the waters a little bit. So we'll keep a keen eye on next month's figure as well.
Well, just given the state of play at the moment, James, do you think this could force the Reserve Bank's hand when it comes to cutting interest rates again when they meet later on this month?
I think the later on this month will be a bit too soon. As I say, with the World Cup, I still think we'll need to see some productivity levels and more employment levels. So perhaps the September meeting would be a more likely area that we could expect a change in policy. Yeah, I think we can expect a drop, obviously, in construction employment around the World Cup. So inflation at the moment is benign. It's in line with their expectations, though. So certainly they will be looking at this number. They will be taking into consideration the rest of the international market, making strong signals that interest rates will remain lower for an extended period. So I certainly think the chances are increasing that we may see an interest rate cut. The market is still only discounting around a 40 to 45% chance of a 50 basis point cut in the cycle, but that I think will increase in its likelihood if these figures still come out the way they are and the way this PMI is suggesting they will be.
Well, following all the data we've seen out this week, we're really all focused on the non-farm payrolls numbers that come out of the United States tomorrow evening. And of course, we had those ADP jobs numbers yesterday, perhaps a precursor for what we can expect tomorrow, James.
Yeah, the private sector jobs were very disappointing, and that could be sending a warning ahead of tomorrow's non-farm payrolls. That's probably the biggest number that the market looks at, and it is obviously expected from a large, perhaps inflated number because of the census last month. It's expected to come in as a negative figure of around 110,000 this time. The market really at this point needs a positive number there to turn things around from this really negative sentiment that is in the world at the moment.
Anything worse than 110,000, then we could expect a further pullback in the markets, I presume.
Yeah, that's right, obviously. Yeah, anything, I think we would need to see a sort of neutral number to get a remarkable sort of retracement. But yeah, anything worse than what is expected, as perhaps the private sector jobs were hinting, and I think the markets are going to be in for more pain.
Well, just some more of the things that are forcing the markets at this point. We had Moody's yesterday putting Spain on a ratings watch. And of course, that came as European banks prepared to repay those 442 billion euros in emergency liquidity that they'd withdrawn from the ECB. So another couple of factors really putting pressure on currencies and bond yields globally.
That's it, yeah. The euro actually benefited this morning with the 12-month loan that you were referring to, rolled over on a 3-monthly basis, and the take-up not as high as the market was anticipating, meaning that the funding requirements aren't as dire or as drastic as perhaps the market was expecting. So the euro benefiting earlier on today as a result of that. But yeah, certainly with Spain being put on a sort of rating watch for a potential downgrade from Moody's, just that, yeah, it's contributing and to the negative sentiment around Europe at the moment.
Well, just looking at where we are halfway through the year, as Alicia said earlier, we've had the rand weakening slightly against the dollar this year, not looking so bad against the crosses, but really equities for the year to date are down 4%. Cash and bonds would have been your best bet, really, if you were an investor.
That's it, yeah. With the old 2020 hindsight, it's easy to say that, I suppose. But you could also argue that the rand not necessarily at the moment reflecting that, really. Certainly, the fixed income market is seemingly taking preference internationally at the moment. So we'll probably see that spill through again to our interest rate markets as well. But yeah, I think the rand at the moment, still doing relatively well given the equity market move and where the rands come from at the start of this year. So that is something to bear in mind as well.
And of course, a lot of that support for the rand has come for carry trade with foreign investors coming into our markets. Would you expect that carry trade to continue into the second half, particularly with foreign investors coming into our bond markets?
Yeah, there's still a global appetite for yield, so it will still be there. It all just depends, I suppose, on relative risk appetite in the world and whether that continues. You'd expect with our relatively higher interest rates and stable-ish currency that should continue certainly going forward, yeah.
And the rand from these levels, just given the risk aversion in the markets at the moment, would you expect the rand to maintain these weaker levels at the moment?
Yeah, I mean, today's range looks to be around sort of the mid-760s up to around 778. I think the market's talking about concerns over the Eskom strike next week, so that's seen the rand trade pretty poorly today. Also, commodity-based currencies having a bad day as well today, I guess, based on the sort of the lack perhaps of potential demand for commodities going forward. But to put a range on the rand for the week is difficult with tomorrow's non-farm payroll numbers, but anything can happen there. But it certainly looks like that the rand could certainly weaken in the next couple of weeks.